we just went over some basic accounting terminologies. Now let's look at the 10-step accounting processing cycle. The first step, the source document. So what is a source document? Here's a receipt that I get that I went shopping this morning. Sometimes if you go to a bakery or if you go to a restaurant, you're going to get a receipt like this. So it's usually after you did your order, the cashier will print out a receipt. A cashier will collect your money and print out a receipt, give it to you. At the same time, if you has ever noticed, the cashier may print out another copy of the receipt and put it beside. So that as a copy of the receipt, that is a source document. Maybe later in the day, the cashier is going to give it to the accountant of the firm. And then accountant will use that receipt as a source document. And the accountant will rely on that and move to the next step of the accounting processing cycle. The accountant will analyze the transaction analyzed. So what is transaction analyzed? The accountant will look at this receipt and it will know that a sale was made this morning. So which means that the sale of the firm, so the revenue of the firm will go up. And then maybe the cash or account receivable will go up as well. So that is called transaction analysis, to analyze the transaction, what elements are involved, and whether those elements there's an increase or decrease regarding those elements. And then after that, after all of the elements are identified, the accountant can make a journal entry based on it to recording journal, make a journal entry. So what is that journal entry? The journal entry. So if you are in a bakery, so if you bought a bread, so the journal entry is probably, and if you bought the bread using cash, the journal entry is to debit cash, credit sales, right? So that is the journal entry to debit. For example, the journal entry is to debit cash for $10, credit sales for $10. So this is called a journal entry. And then the next step is to post to ledger. So post to ledger is basically to post to different accounts. So we first posted to the cash account, cash increased by $10. And then sales increased by $10 as well. And the increase in sales is at the credit side. And then the next step, unadjusted trial balance. So at the end of financial reporting period, before we make adjusting entries and closing entries, we're going to collect the balance for all of the accounts and list them on a report. So for example, the balance for cash is 100. The balance for sales is 250. And then we just list all of the balance for all of the accounts. And then record and post adjusting entries. So there are some additional entries. There are some additional entries we need to make, but it doesn't involve a source document. So for example, depreciation, that is one kind of adjusting entry, and we're going to talk more about it in a minute. So for those entries which doesn't involve a external source document, at the end of the financial reporting period, after the unadjusted trial balance, we need to record and post adjusting entries. And then after we have posted those adjusting entries, the balances for some of those accounts will change. So we're going to update this trial balance to an adjusted trial balance. And after that, using the balances from adjusted trial balance, we can make financial statements. And then, so at the end of the financial reporting period or at the end of the year, we need to make closing entries. We need to closing all of the temporary accounts into permanent account. And then after we have made the closing entries, we are going to have a post-closing trial balance. So some of the account balance will change as well. And then we're going to have a new updated trial balance, the post-closing trial balance. So those are the 10-step accounting processing cycle.